This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. We are diving into the biggest shifts in global finance, technology, and consumer markets. From housing trends to AI restructuring, we have the essential details for you.
UK house prices rise despite growing Middle East tensions.
Tech companies use AI to justify massive workforce restructuring.
British energy bills face an unavoidable surge this July.
American gas prices cross the $4 gallon threshold.
OpenAI cuts projects to find a path toward profitability.
Instagram tests paid subscriptions for anonymous story viewing features.
Oil prices dip on reports of potential war de-escalation.
Allbirds sells for millions after a $4 billion valuation.
UK car finance victims set for higher average payouts.
Carnival warns of lower profits as fuel costs spike.
Starting with UK housing. The UK housing market is showing surprising resilience, with nationwide reporting a 0.9% rise in house prices for March. This brings the annual growth to 2.2%, suggesting the market regained momentum after a sluggish end to last year. However, Robert Gardner, the chief economist at Nationwide, warns this might be the calm before the storm. The sharp rise in global energy prices due to Middle East conflicts represents a significant shock. This could lead to slower economic growth and higher inflation, making the future of interest rates incredibly uncertain for homeowners.
It is a complex picture because while prices are up, the underlying financial mechanics are shifting rapidly. Before the recent strikes on Iran, markets were actually anticipating 2 interest rate cuts. Now, they are pricing in 3 increases over the next year. This shift has caused a spike in the swap rates that determine fixed-rate mortgage pricing. If these higher rates persist, they will likely reverse recent improvements in housing affordability. Tom Bill from Knight Frank notes that because mortgage offers last 6 months, we will really see the impact of these higher borrowing costs filter through this summer.
Next, the AI layoffs. There is a growing narrative that artificial intelligence is stealing jobs, but the reality is more about corporate restructuring than a robot takeover. Companies like Meta, Oracle, and Block have cut thousands of positions recently, often citing AI as a factor. However, analysts suggest these layoffs are frequently a strategy to free up capital for AI investment rather than AI actually performing the work. Interestingly, nearly 30% of hiring managers who eliminated positions have already reopened them. It seems many firms are letting full-time staff go only to replace them with contract or temporary workers to save on long-term costs.
This shift is creating a significant erosion of employee loyalty. While 92,000 job cuts have been linked to AI since 2003, Gartner analysts point out that these are not necessarily results of AI successes. Instead, companies are betting big on future gains at the expense of current worker security. We are seeing a move toward a more contingent workforce, which has been a trend for decades but is now accelerating under the guise of technological advancement. It is less about the software being ready to do the job and more about the financial pressure to win the generative AI race.
Moving to energy costs. British households are facing a tough summer as energy bills are predicted to surge by £288 a year starting in July. Cornwall Insight has warned that a rise in the Ofgem price cap is effectively unavoidable due to rocketing wholesale costs. While there was a slight dip in the forecast recently due to signals of a potential ceasefire, the prices locked in during March are already set to impact the calculation. This 18% increase will bring the typical dual-fuel household bill to nearly £2,000, putting immense pressure on families already struggling with the cost of living.
The timing provides a small amount of relief since energy demand is naturally lower during the summer months. However, the real concern lies with the October price cap, which is when the government may need to revisit support measures. Energy Minister Martin McCluskey has stated that tackling affordability is a top priority and that the government is prepared to intervene if necessary. For now, the focus is on the May 27th announcement, when Ofgem will confirm the final level. It is a stark reminder of how geopolitical instability in the Middle East directly translates to the monthly expenses of people in the UK.
Now to gas prices. In the United States, the national average for a gallon of regular gasoline has officially crossed the $4 mark. This is a significant psychological and financial threshold for American drivers. Prices have surged rapidly since late February, largely driven by the conflict between the U.S., Israel, and Iran. With the Strait of Hormuz seeing major disruptions, 20% of the world's oil supply is at risk. This has pushed Brent crude to multi-year highs. For many households, this spike is not just about the commute, it is a catalyst for another round of inflation across the entire economy as transport costs rise.
The regional differences are quite stark, with California drivers paying nearly $6 a gallon, while Oklahoma remains the cheapest at around $3.27. Beyond the pump, retail analysts warn that these costs hit small businesses the hardest. When gas is expensive, consumers make fewer shopping trips and spend more cautiously. This environment tends to benefit giants like Walmart and Amazon, which offer one-stop shopping or delivery, while specialty retailers suffer. We are also entering the season for summer-grade gasoline, which is more expensive to produce, meaning there is little hope for immediate relief unless Middle East tensions ease.
Shifting to OpenAI's strategy. OpenAI is currently valued at a staggering $850 billion, but as it eyes a potential stock market flotation, the pressure to turn a profit is mounting. The company is reportedly spending $600 billion on infrastructure and data centers through 2030. While this is a reduction from earlier estimates, the startup is still burning through cash at an alarming rate. To prepare for the public market, Sam Altman has been making some tough calls. In the last month alone, OpenAI has scrapped several high-profile projects, including an in-app shopping feature and its video generation platform Sora, which was proving to be a money pit.
The decision to ditch Sora was particularly surprising given a billion-dollar deal at Disney was on the table. It seems the technical and financial costs of generating high-quality video were simply too high for a company trying to slim down. They also pulled the plug on a plan for erotic chatbots, likely to avoid the massive regulatory and safety nightmares that would follow. Analysts suggest these moves show OpenAI is moving away from being a public demo of cool tech and toward becoming a sustainable business. If they want to float this year, they have to prove that the AI party can actually pay for itself.
Next, Instagram's new features. Instagram is testing a new subscription model that might change how we interact with stories. The most talked about feature is a stealth mode that allows paid users to view someone else's story without appearing in the viewer list. This pilot is currently running in Mexico, Japan, and the Philippines, with costs ranging from $1 to $2 a month. It is a clear move by Meta to diversify its revenue streams beyond traditional advertising. By offering these premium perks, they are following the lead of platforms like Snapchat and X, which have already introduced paid tiers to make their monthly income more predictable.
Beyond the anonymous viewing, the subscription includes the ability to create more specific audience lists and extend the life of a story by an extra 24 hours. Meta has been aggressive with paid products lately, including the Meta Verified service, which can cost up to $500 a month for businesses. This latest test targets the average user's social habits. While it might be a hit for those wanting to keep tabs on others privately, it adds a new layer of complexity to social media privacy. It will be interesting to see if users are willing to pay for what used to be a free, albeit public, interaction.
Now for oil markets. Oil prices saw a sudden reversal in Asian trading following reports that Donald Trump might be open to ending the U.S.-Israeli war against Iran. Brent crude futures dropped over 1% to around $111 per barrel. The report suggested that Trump told aides he was willing to end the military campaign even if the Strait of Hormuz remained partially closed. This provided a temporary sigh of relief for markets that have been on edge. However, analysts warn that any meaningful price drop won't happen until the waterway, which carries 20% of global oil, is fully reopened and the damaged infrastructure is repaired.
The volatility remains extreme. Just before this dip, prices had risen 2% in a single session. The reality on the ground is still very dangerous, as evidenced by an Iranian projectile reportedly striking a Kuwaiti tanker at a Dubai port. Iran's closure of the strait has already caused the highest monthly gain for Brent futures ever recorded. Even if diplomatic signals improve, the physical supply remains incredibly tight. Experts believe uncertainty will persist for the foreseeable future, especially with fresh concerns about other choke points like the Bab el-Mandeb. The market is reacting to headlines, but the supply chain remains fundamentally broken by the conflict.
Turning to Allbirds' sale. The fall of Allbirds is a cautionary tale for the direct-to-consumer industry. Once valued at $4 billion during its 2021 IPO, The sustainable footwear brand has just been acquired for a mere $39 million by American Exchange Group. Allbirds became famous for its wool sneakers, which were a staple for tech workers and venture capitalists. However, the company has struggled with declining revenue every single quarter since 2022. They have been forced to close nearly all of their 50 global stores as losses mounted. It is a dramatic end for a brand that once seemed to have the perfect formula for modern retail success.
The company's mission was to make better things through nature, and they were a pioneer in the B Corp movement. They even hit their initial Kickstarter goal in just 5 days back in 2016. But the transition from a buzzy startup to a profitable public company proved impossible. By the end of 2025, their quarterly revenue had dropped over 23% year over year. The acquisition by American Exchange Group marks a total collapse in valuation, losing over 99% of its peak worth. It highlights how difficult it is to maintain momentum in the fashion world, even with a strong environmental message and celebrity backing.
Next, car finance payouts. Victims of the UK car finance scandal are now expected to receive higher average payouts of £830. The Financial Conduct Authority has narrowed the scope of its compensation scheme, reducing the number of eligible contracts from 14 million to 12.1 million. This change means the total compensation pot will be around £7.5 billion. The scandal involved drivers being overcharged for loans due to hidden commission deals between lenders and dealers. While the total bill for banks is lower than some analysts feared, the regulator is pushing for these payments to be made quickly to help households facing rising bills.
FCA Chief Nikhil Rathi has warned banks not to delay these payouts through legal challenges. He emphasized that delivering this compensation is a chance for lenders to rebuild trust after years of overcharging. However, the industry has until late April to challenge the scheme, and some lobby groups haven't ruled out taking the matter to court. If they do, it could significantly delay the millions of people expected to get their money by the end of 2026. For many, this payout will be a welcome relief, but the legal battle between the regulator and the finance firms is far from over.
Finally, Carnival's profit warning. The cruise giant Carnival has been forced to cut its profit forecast as the war in Iran sends fuel costs soaring. This is a clear sign that the economic impact of the conflict is reaching far beyond just airlines and hotels. Oil prices have jumped more than 60% since the war began, and Carnival is particularly vulnerable because it is the only major U.S. cruise line that does not hedge its fuel costs. This means they are paying the full market price for every gallon, which is eating directly into their bottom line, despite seeing record revenues and strong booking growth in the first quarter.
It is a frustrating situation for the company because consumer demand for cruising is actually at an all-time high. People want to travel, but the geopolitical situation is making the operations incredibly expensive. Without fuel hedging, Carnival is at the mercy of the daily fluctuations in the oil market. This profit warning serves as a bellwether for the broader travel industry. Even if people are willing to spend money on vacations, the rising cost of energy could force many companies to raise prices or accept much thinner margins. The fuel shock is proving to be a major headwind for the post-pandemic travel boom.
That wraps up our briefing for today. Thank you for joining us for this daily update on the stories that matter. We will be back tomorrow with more insights.